สวัสดีค่ะทุกท่านยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะหรือ PSL นะคะโดยการนำเสนอข้อมูลโดยคุณคาริดฮาชิมกรรมการผู้จัดการเรานะคะในเรื่องของอุตสาหกรรมการเดินเรือและจะต่อด้วยคุณกอตั้มคุรานากรรมการการเงินในเรื่องของผลการดำเนินงานตัวเลขทางการเงินและในช่วงสุดท้ายคำถามคำตอบนะคะถ้าท่านใดมีคำถามก็สามารถคีย์เข้ามาในระบบของตลาดหลักทรัพย์ได้เลยค่ะเพื่อไม่ให้เป็นการเสียเวลาขอเชิญคุณคาริดค่ะ
Thank you, Som. We will do the presentation in two parts. In the first part, we will talk about the dry bulk freight markets. And then in the second part, Gautam will walk you through all the financials of the company. So you can see here on this slide, what has happened to the BDI starting out in January 2016 and all the way up to the end of last week. So you can see that the BDI is still at a very healthy 1558 number. If you look at China, it has been extraordinary. If you look at the Q1 results of this year versus Q1 results of last year, and then compare with the whole year of 2022 versus 2021, what do you see? In terms of iron ore, you can see quite clearly that the iron ore is up in Q1 by 9.7%, and last year was down by 1.6%. If you look at coal imports, it's up by 96.5% as against last year's coal, which was down by 9.4%. On a year-on-year basis. If you look at steel production in the first quarter, it is up by 5.3% as against down by 1.8% last year over the year before. If you look at steel imports, it was down by 40.6% in the first quarter, and last year was down by 26.3%. If you look at steel exports, it was up by 52.4% versus up by 0.9% of last year over the year before. And steel consumption was up by 2.1% in the first quarter versus minus 2.3% for the whole year last year. So you can see clearly that China is really performing well, and we have just seen the numbers come out for the month of April, and they are even stronger. If you look at the total trade that has been taking place, which is the third last row from the bottom, you can see in ton-mile terms that for 2021, it was 3.48%. And if you look at the last row in that same column for 2021, you will see that fleet growth was 3.55%. And yet in 2021, we made $137 million of net profit. If you look at 2022, Clarkson says that last year, ton-mile demand grew by minus 1.69%, whilst fleet growth was at 2.86%. And yet, in 2022, PSL had $2 million more net profit than in 2021 at $139 million. If you look at the forecast for 2023, it is plus 1.92% in terms of ton-mile demand, whilst the fleet change will take place at plus 2.7%. And if you look at 2024, it's even better with a 2.26% growth in ton-mile demand, whilst the net fleet growth will be just 0.6%. If you look at just minor bulks and look at 2022, you can see that minor bulks 2021, you can see that minor bulks grew by 5.11%, as against that the smaller size or the geared ships grew by 2.45%. If you look at 2022, Clarkson says that minor bulks grew by minus 1.51%, but fleet grew by 3.22%. If you look at 2023's forecast by Clarkson's, it is 1.28% growth in ton-mile demand for minor bulk. Against that, the fleet growth is just 1.9%. And for next year, it's a staggering 3.24% growth rate compared to just 0.8% growth in net fleet growth. So you can see that for the minor bulks, trade is growing and supply is growing, but slowly. And this shows you what's happening with all our cargoes that we've been carrying. Other than coal, which you see here in the middle, all others are minor bulk cargoes. If you look at the types of cargoes that each of the ships carry, you can see that Capesizes spend 74% of their time on iron ore, 19% of the time on coal, and 7% of their time on one minor bulk cargo, which is bauxite, which is a raw material for aluminium production, And they get it from West Africa, where they own the port, they own the mines, and they own the ships that transport them. If you look at Panamaxes, you can see that they spend 52% of their time on coal, 8% of the time on iron ore, 25% of the time on grain, and 15% of the time on minor bulks. But when you come to Supras and Handys, what do you see? You see that Supras and Handys spend an inordinate amount of time on minor bulks, 54% for Supras, 66% for Handys. And this maybe explains why for the last 2 years we've done really well and better than the bigger ships, because our dependence on minor bulks is much stronger than it is on major bulks. If you look at the last row and the last column in the lower part of the slide, you will see that totally the fleet grew in the first quarter of this year by 9 million deadweight tons, of which 3 million deadweight tons came from the smaller sizes and 6 million deadweight tons came from the larger sizes. So you can see that the larger sizes are growing at roughly twice the speed of the smaller sizes. If you look at this slide, it shows you that the total forward order book all the way to the end of 2026 is at 66.79 million deadweight tons, or 6.85% of the total fleet which is there in existence as of the 1st of April of this year. And we show you the bar charts to show you what it is per sector. If you look at this slide, we are showing you that based on our assumption of 5% slippage and 8 million deadweight tons of scrapping in 2023, that the fleet growth will be at 2.90%. But remember, Clarksons are forecasting that the deadweight for scrapping for 2023 will be double this number at 16 million deadweight tons. So we're assuming a much more conservative number for scrapping. If you look at this slide, it shows you that at the start of 2009, the forward order book was at 78% of the existing fleet at the start of that year. And if you look at the red line, which is between the two other lines, which is the 20-year-old fleet, you can see that it is for the first time larger than the forward order book. So if you look at the forward order book today, as of the start of the second quarter, it is at 6.85%. But if you look at the 20-year-olds, which is there on the top block of numbers, the 20-year-old fleet is at 8.11%. So this ratio explains and tells us that in the future, we should do much better than we have done so far in the past. The same thing is there for Supras and Ultras, but is much more magnified. In the handy size, you can see that it is at 3.69% is the order book, but the existing 20-year-olds today are at almost 15%. If you look at the Supras and Ultras, it is at 9.61% is the forward order book versus the fleet, and the 20-year-olds today are at 11%. So again, you can see quite clearly that these are going to be, the fleet sizes will continue to get smaller and smaller. This slide shows you what are the differences between the various periods of time. 2003 to 2009 was the big bull run. 2010 to 2020 was a big depression. 2021 was a very good year for us. Similarly, 2022 was a very good year for us. And we expect that 2023 should turn out reasonably well based on all the figures that I'm trying to show you here. So if you look at these figures and look at the fifth row from the top, you can see that demand in billion ton miles per year during the bull run of 2003 and 2009 averaged 5.4% per annum at the start of each, for each of those years. In 2010 to 2020, it dropped to 4.2%. In 2021, it dropped to 3.48%. By 2022, it was minus 1.69%. And in 2023, it is forecast to be 1.92%. If you look at the speed, which is the next row, you can see that the average speed in the big bull run was 13.5 knots. In 2010 to 2020, it dropped to 11.5 knots. In 2021, it was at 11.4 knots. In 2022, it dropped to 11.2. And so far in the first quarter of 2023, it's dropped to 11 knots. So you can see the speed is reducing. Every 1 knot reduction in speed by all ships in the world means that the net supply reduces by 5.5%. If you then come down to the 20-year-olds, which is the second row from the bottom, you can see that at the start of each of the years during the big bull run, it was 18.38%. And in the period 2010 to 2020, it was at 11.27% at the start of each year. If you look at 2021, it had dropped to 6.25%. At the start of 2022, it was 7.26%. And at the start of 2023, it was 8.07%. So you can see this ratio compared to the forward order book has finally reversed. In other words, 20-year-olds today are larger than the entire forward order book as a percentage of the existing fleet. And if you look at the start of 2023, it has become even larger at 8.11% for the 20-year-olds versus 6.85% for the forward order book up to 2026 compared to the existing fleet as of the start of Q2 of this year. Now, these show you the average speeds during different periods of time. 2012 to 2020 is the first bar, 2021 is the second bar, 2022 is the third bar, and the first quarter of 2023 is the last bar. So you can see clearly in whichever size you're looking at, speeds have continued to drop. If you look at port congestion, between 2016 and 2022, you could say an average of about 31% was the congestion number. And if you look at the start of 2023, it is at about 32%. So not much change in the congestion levels over the years. If you look at the BDI, which is in the second column, and compare the first quarter of 2023 versus the first quarters of the previous 3 years, you would see that 2023 first quarter was lower than the first quarter of 2022 by 50%, minus 42% from the 2021 number, and plus 71% compared to the 2020 number. If you then compare the orders placed during the first quarter of 2023 at 2.4 million deadweight tons and compare it with what happened in the first quarter of the previous 3 years, you see that it was minus 75% compared to 2022, minus 82% compared to 2021, and minus 59% compared to 2020. So why are ship owners not ordering new ships? And there are 3 main reasons for it, which I've outlined for you here. First is that we have been crowded out from the shipyard capacity by other ships, other types of ships. And the earliest we can get ships now is actually 2026. If you look at shipyard capacity, it's come down by 40% compared to the active large yards in 2022 versus what was there in 2009. And the main reason is that despite bulk carrier owners having lots of money to invest in new ships, current legislation and expected regulations will expedite the death of the internal combustion fuel oil burning ships, and the fear that such ships may become stranded assets is constraining the order book. Now, what are the key takeaways for the industry? The first one is that the IMF estimates global growth, GDP growth, to be at 2.8% in 2023 and 3% in 2024. But Chinese GDP growth will grow by 5.2% in 2023, already a 0.8% increase over the IMF's previous forecast in January. So this forecast was made in April. The actual GDP growth rate in Q1 was 4.5%, yet major American banks estimate China growth to beat IMF forecast by between 100 to 150 basis points in 2023. Why are they making this type of a forecast? Is based on what they see in terms of the recovery. Please remember, in Q1, China got hurt by 2 big things. The first big thing, of course, was that they went from a COVID zero policy towards the end of last year to a no COVID policy, which means they opened up the economy completely and there were no more lockdowns, etc. So in the first 2 months of Q1, there was a lot of people getting infected by COVID. Happily for China and for the rest of the world, there was not much of, how shall I say, death rates in China, and therefore they came out of the COVID in a reasonably good shape by the end of Q1, and that is the reason why you see that the Q1 numbers for China have been so strong. Secondly, demand growth of 1.5 to 2.5% in 2023, according to Clarkson, will be driven by the China's economic recovery. In Q1 2023, China's fixed asset investment was already up by 5.5% and consumer spending had rebounded. If you look at the iron ore imports for China, you can see that Brazil performed well in the first quarter, and therefore this pushed up Cape rates in Q1. As of yesterday evening, Cape rates went up by more than $1,000 to straight to $20,000 for the first time in this year. They have exceeded $20,000 a day. China, the forward order book to fleet ratio is at 6.85% as of 1st April and is lower than the existing 20-year-old fleet at 8.11%. The dry bulk fleet is forecast to grow by 2.7% in 2023 and by 0.6% in 2024. But net supply will be reduced by between 2 and 2.5% in 2023 and 2024 due to lower speeds due to EEXI and CII regulations. The supply demand will continue to improve. Rates have already started recovering as demand picks up in China, and since 2023, we have got 16 ships fixed on index-linked long-term charters, which have started to benefit. Just quickly on the new regulations, EEXI came into force on the 1st of January 2023. Somewhere between 70 and 90% of all dry bulk ships will be impacted. For us, 23 ships are impacted, of which 16 ships will have to reduce speed by between 1 and 2.5 knots. The cost for us for doing this exercise has been about $1 million. Actually, it's a little less than that. And it shows you what is the ships where there is no requirement for any form of the ships to meet in terms of EEXI, and where there is a requirement to meet the conditions of EEXI, then what is the cost? And the implications are simply that the effective supply of ships will drop by 5.5% for every 1 knot speed reduction in the world fleet. Similarly, for carbon intensity indicator or CII, it came into force from 1st January 2023, and it's an annually reducing grams per ton mile of cargo carried. And this will continue, the reference line will be from 2023 to 2026. Approximately 30,000 ships of 5,000 gross tons and above, or about roughly 20,000 deadweight tons and above, will be impacted by CII. How will we manage CII? First of all, by using a lot of fuel-saving devices, and secondly, by making sure that the ships are in optimum condition by blasting and painting them in the dry dock with high-quality paints. And we will optimize the operations through good routing, etc., and ensure our ships are in good condition to meet these requirements. We have a slide here which shows you how DNV, which is a major classification society based in Norway and in Germany, how they see it. They see that by 2026, 62% of the world fleet in dry bulk, which is impacted by EEXI and CII, will not be able to perform. They'll be in the D or E category, which means that either the world has to ship 62% less cargo, or they have to revise the rules of CII. And we think that the CII rules will be revised, because right now there is no penalty involved if you fail in, you get a D rank or an E rank, which is a failure rank. You don't have any penalty at the moment, and I think that they will start to introduce some penalties going forward. So what is our strategy? First of all, our fleets. If you look at our fleet, we've got 38 ships. The average age is 11.2 years. The insured value is at $765.4 million. The book value is $628.4 million. The total deadweight is 1.7 million deadweight tons approximately, and the average size is approximately 44,000 deadweight. In terms of market performance, our handy-sized ships outperform the index by 1.5%, and our Supras, Ultras outperform the index ships by 0.62%. But remember, our handy ships are rated at a discount of 25% due to size and fuel consumption, and similarly, the Supras are at a 10% discount due to similar reasons. Now, this is our forward book. If you look at 2023, we have got 6,725 days already pre-booked, which is 48% of the total available days. And we pre-booked that at $13,870 per day as of the start of this year. Now, keep in mind, these numbers will keep changing as we have a lot of ships fixed on index-linked charters. So as the indexes go up or down, this number will change. Now, if you look at next year onwards, you can see that the rate, the percentage drops, but the rate goes up because these are the longer-term fixed price contracts that are coming into play now. With that, I will hand over to Gautam for the financials of the company.
Thank you. So for the quarter, we had a net profit of about 78.69 million or $2.31 million or 5 satang per share. The EBITDA was about 424 million or 12.47 million USD. In terms of financing, on 27th of April this year, we completed the drawdown of a $9 million loan from EO Bank. This is a Japanese bank. So we worked with the Singapore branch of this Japanese bank. And we used the proceeds to prepay a 4.1 million loan from Sinopac, which is a Taiwanese financial institution. Year to date, we fixed 4 ships on long-term contracts at variable rates linked to the underlying index for vessels of that size. And in aggregate, we have now 5 ships that are on long-term fixed rate charters and 16 ships on long-term charter contracts at a variable rate. So some key figures in Q1, our total revenues were $34.6 million compared to $46.5 million in Q4 2022. Net profit was lower at $2.3 million compared to $15.3 million in Q4 2022. Earnings per share in baht was 5 satang compared to 35 satang in Q4. The return on equity was 1.34% compared to 30.6% in Q4. Our net debt to equity ratio remained the same at 0.34. And the number of ships that we had also remained the same at 38. So this over here shows you the changes. So on the top left, you can see the changes in the time charter, the average time charter rate per day earned by ships in our fleet. So you can see in Q1, the rate was 10,022 compared to 14,343 in Q4. The EBITDA was also lower at 12 million compared to 28 million in the previous quarter. And so here's the bottom left, you can see the dividends that we paid. So the dividend for the first quarter is something we will decide upon at our board meeting next week. And over here on the bottom right, you see the cash that we have on balance sheet. This over here shows you the statement of financial position. So you can see that our shareholders' equity position has remained fairly stable. That's at 477 million at the end of this quarter compared to 476 million at the end of last year. Total vessels and equipment is slightly down because of depreciation it went from 638 million to 631 million. Our total loans are also down. So despite the despite the new loan that we took on, although that was in April, but okay, so the loan position, the total loans are down from 194 million at the end of last year to 185 million at the end of Q1. This over here shows you the cash movement in Q1. So you can see at the end of last year, we had 30 million of cash and cash from operations was 9 million. We had CapEx, so comprising mainly dry dock expenses, that was 2 million. Interest payments of 3 million, debt repayment of 8 million, and also prepayment of 1 million. And so that resulted in a net cash position of 25 million at the end of the first quarter. This over here shows you the breakdown of our operating expenses per day per ship. So in Q1, there was a slight increase in our operating expenses, mainly due to an increase in the stores and spares expenses, but also because of an increase in the dry dock and special survey expenses. Otherwise, expenses have remained fairly stable. This over here shows you our operating expenses compared to the industry average. So for the year 2021, which is when the last report, industry average report was published by BDO, we were about $450 per day lower than the industry average. Now every $100 in savings over here translates to about $1 million on the bottom line. The operating expenses for the year 2022, that report will be published by BDO, we expect in November 2023. So over here we show you the EBITDA per ship in Q4 and also the last 12 months for other listed companies that own Supramax and Ultramax ships. So you'll see that compared to many of our peers, other listed peers, our EBITDA per ship, both for Q4 as well as for the last 12 months, that means being for the year 2022, is higher. This over here shows you our debt maturity profile. You'll see that we have a fairly even debt maturity profile with not very high balloons payable over the next few years. And in fact, this debt maturity will get extended over the next 12 months, I would expect, as we refinance some of our debt that is coming due. This over here shows you the net debt and net debt to equity ratio. So you'll see that the net debt to equity ratio, it peaked in 2016 and 17. It was 1.1, but since then we've paid down our debt quite considerably, and it is now down to 0.3, or so the net debt is down to 160 million compared to 412 million in 2017. Okay, so over here we show you the average OPEX and TC rates since 2000 until now. So if you look at the top row, first of all, so in the top row you'll see that it shows you the average age of ships that we owned in our fleet. So you'll see from the year 2000 until the year 2011, the average age of our fleet was relatively old. So it was at 14.2 back in 2011. And then it started to decline as we took delivery of a number of new buildings. It came down to its lowest level in 2016 at 5.8, and now it's at 11.2. Now, many of these new buildings were larger ships, and so this red line over here shows you the average size of ships. So you'll see that the average size of ships that we owned in the past was 22,000 deadweight, and then that increased as we expanded into the Supramax and Ultramax sectors, and the average size is now at about 43,621 deadweight. This line over here shows you the time charter rate per day for the fleet, and you see that we've gone through several cycles. So the last big up cycle, if you will, was during the 2004 to 2009 period when China joined the WTO and underwent a building boom. But this was at the same time that there was a large order book. As you would have seen, the order book was at 78% of the existing fleet, and those ships were delivered between 2008-9 and 2015-16, and that kept rates quite depressed. Now those orders then stopped. Yeah, so the deliveries of those ships, those new building ships, then stopped, and that helped rates increase from the year 2016-17 onwards. Over here, this shows you the operating expenses per day for our fleet, and which has remained fairly stable. Over here, we show you the dividends that we have paid over time. Our policy is to pay not less than 25% of net profit as dividend. We reinstated dividends after a gap of 7 years in 2021. And in 2021 and 22, we paid 61% and 56% as a percentage of EPS as dividend. This over here, we are showing you the figures, which I will leave you all to refer to. So in the year 2021, PSL was ranked 10th overall in Marine Money's 2021 ranking of financial performance. This is among 83 listed shipping companies globally. And within the dry bulk sector, we were ranked number 2 of 22 listed companies. So just on ESG, so we have always been working quite hard to reduce our environmental footprint. So we replaced our older, less fuel-efficient vessels between 2013 and 17 with eco ships. This resulted in a reduction of our CO2 emissions, and the fleet's average gram CO2 per ton nautical mile reduced from 12.884 in 2014 to 7.14 in 2022. A large part of our fleet is also fitted with energy-saving devices such as Mavis ducts, pre-shrouded vanes, and hub vortex absorber fins, leading to energy savings ranging between 3 and 5%. We have a formal environmental policy statement since 2009, based on ISO 14001 and 2004 standards, which were updated to 14001 and 2015 standards. Now, this is unusual for a dry bulk company. This is something that normally tanker companies would have. We are a founding member of the Getting to Zero Coalition, which is an alliance of about 150 companies that are connected to the maritime sector. And this coalition, the mandate is to explore commercially viable zero carbon emitting vessels, or ZEVs. We are a signatory to the Neptune Declaration covering seafarer well-being and crew change. We've been providing scholarships to students of the Merchant Marine Training Center, as well as donations for other activities since 1995. We provide scholarships to about 42 students each year. We've also been supporting the Mechai Patana School in Buriram province. Several of our employees, 42 of our employees, volunteered to clean up Banampur beach in Chonburi as part of the World Maritime Day celebration in 2022. In 2021, we provided 60,000 free meals over a period of 3 months for the needy in Bangkok. We've been included in the SET's THSI list for 2022. We received the Outstanding Investor Relations Award from the SET for 2 consecutive years. We received the 2021 ASEAN Asset Class Award for having attained a minimum CG score of 97.5 on the ASEAN CG scorecard. We've been classified as a company with excellent corporate governance for 13 consecutive years from 2010 to 2022 by the IOD and the National CG Committee. And we received 100 full AGM assessment score points for the 5th consecutive year from 2018 to 2022. We are certified as a member of Thailand's Private Sector Collective Action Coalition Against Corruption, or CSC, since August 2019. We were the highest ranked global dry bulk shipping company in the S&P Corporate Sustainability Assessment ranking. So it's like an ESG ranking in the year 2021. And we were also in the top 12 percentile of global listed transportation companies for the year 2022. So some final food for thought. So we expect that demand will grow well at a healthy level over the next few years. We're a Thai corporate, but we have zero business out of Thailand. So the weaker the Thai baht, the stronger our EPS in Thai baht, as all our income is in US dollars. We believe that price to book value is not a good measure anymore, as asset values have fluctuated significantly up and down since the start of the pandemic. Our debt continues to shrink, which is, of course, good news for our shareholders. Demand growth is expected to be 1.5 to 2.5% in 2023, and this will be driven in large part by China's economic recovery led by its reopening after COVID. The dry bulk fleet is forecast to grow at a very low 2.7% in 2023 and even lower 0.6% in 2024. And we expect a further boost as we expect net supply to reduce by 2.2 to 2.5% in 2023 and 2024 due to lower speeds while ships have to comply with the new EEXI and CII regulations. We expect that supply-demand balance should continue to improve in 2023, and rates started recovering already, as we saw in March after China fully reopened. We've got 16 ships fixed on index-linked long-term charters, which have already begun to benefit. So over here, this shows you the shareholder returns since our IPO in 1993 until today. So if you were an investor in our IPO in 1993, you would have earned a 16.07% compounded annual return. Shows you our investor relations activities. And with that, we are open for questions.
Coming to the questions that have already been asked via the net. So the first question was, please assess the business and industry overview in Q2 2023 and whether it will be better than quarter-over-quarter and year-over-year. How different and why? Okay, first of all, we normally don't give you a quarter-by-quarter review. So really, we have not, we don't do that. And so I will leave this question out just to say simply that the second half of this year should be much better than the first half of this year. And we will know how much better as compared to last year once the year is over. The second question is, what is the forecast for dry bulk shipping rates in Q2? We have not made any forecasts of any rates for anyone. So we will not go into forward-looking statements on what is the earning capacity for pressure shipping. In terms of the third questions, what about bulk cargo demand trends in Q2 23 and second half of 2023? We give you annual numbers, and these are all from Clarksons, and they were all already presented during the presentation. The fourth question is, how many ships in PSL fleet is there currently, and what is the average age? Again, covered in the presentation. We have got 38 ships, and the average age is 11.2 years. And the fifth question is, what is the target rate for the year 2023 on revenue growth? How many percentage growth from year-over-year? We don't have any targets for, or we don't rather give out any targets for any of the years on a forward-looking basis. So I can't answer that question. The sixth question, how much is the investment budget in 2023? How much already has been used in Q1? Gautam?
We don't really have an investment budget as such, and we have not invested in any new ships in Q1.
And the next part of that same question is, how much will be used in Q2 and what sector company plans to invest in with the above budget?
So again, we don't have a budget, and we so far in Q2, we have not made any investments. If we do make an investment, we will certainly make an announcement to the stock exchange.
And then the final question, in 2023, do you plan to sell any vessels? Do you plan to buy new ships? So, okay, so if we have a good opportunity that comes along and we can buy in some younger ships, whether they be new or secondhand, doesn't matter, so long as they're reasonably young ships, they have the latest energy efficiency standards, then we would look at them. And of course, if we buy any younger ships, then at the same time, we will also look at selling off some of our older ships. But there are no plans specifically, if you're asking us. So that answers all the questions which have come on the net.
ท่านใดมีคำถามเพิ่มเติมก็สามารถคีย์เข้ามาสอบถามได้เลยนะคะในช่วงนี้ ส่วนคำถามคำตอบที่ส่งเข้ามาแล้วเนี่ยเดี๋ยวเราก็จะมีสรุปให้ในแล้วก็ขึ้นบนเว็บไซต์ของทางบริษัทนะคะเราจะรอสักครู่ถ้ามีคำถามอะไรเพิ่มเติมนะคะ
Okay, there is one more question. How is EEXI compliance monitored? There isn't a two-tier market where one set of owners comply and another set does not. So this question, I'll answer it by saying that these were the same type of questions that were raised when IMO 2020 was coming about, which is when we were supposed to transit on the 1st of January 2020 from burning high sulfur fuel oil to burning very low sulfur fuel oil. And at that time, the transition on the first day itself had a compliance ratio of higher than 98%. We don't think that there'll be any difference this time around. The EEXI, to remind you, was supposed to have been completed, all the calculations for it, and the engine power limits, if any, were to be put on those ships, that is to slow them down. All that was supposed to have been done last year. So as of the 1st of January, already ships that had been tested by the class societies would have already been performing. The only one gap that is there in the sense that if you have a ship, say, for example, last year, we had one of our ships which was going to have an annual survey in 2023, say in the month of January or February, and we preponed that survey to December of 2022. Then the next annual survey, which would come about in 2023, would be in December of 2023, at which time that ship would have to comply with the EEXI rules and regulations. So that's the only sort of gap that is there that you could think of in terms of a compliance, but it's all as per part of the law. That law says that the compliance must start on the date that you do your annual survey or your special survey or your dry dock survey during 2023, starting in 2023. So most ship owners would have done the compliance part in terms of getting the calculations done by the classification societies during 2022, and would then, whenever they hit that annual survey date, they would complete the survey, and from that date onwards, they'd have to reduce their speeds.
Just to add further, so the question is also, isn't a risk that there is a two-tier market? So the compliance would also be checked by the class societies, by the flag states, and if a particular ship was not compliant, then they would not be allowed to trade. So it's highly unlikely that there will be a two-tier market. There could be some rogue ships that don't comply, but we expect that to be a very small minority.
ไม่มีคำถามเพิ่มเติมที่เข้ามานะคะก็ต้องขอบคุณทุกท่านที่เข้ามาร่วมพูดคุยสำหรับการนำเสนอข้อมูลของ PSL ในวันนี้ค่ะขอบคุณมากค่ะสวัสดีครับ